Well, hello there, and welcome to the Real Estate Crowdfunding Show, syndication in the digital age at gowercrowd.com with your host, yours truly, Adam Gower. Now, have you ever heard the term family office? Basically, what it refers to is a family, as the name suggests, that has such high net worth, it hires people to manage its wealth. Family offices come in all shapes and sizes, from first generation new money, like someone that's had a tech exit or something like that, right? To multi-generational old money. Every real estate sponsor who is raising capital wants to tap into the family office network, because if you can develop a strong relationship, a high net worth family can offer a pipeline for capital that can augment or even replace your other sources. But imagine this. What if you could invest in a family office, not the other way around? Knowing how conservative and discreet family offices generally are, and how careful they are about where they invest and who they invest with, wouldn't it be an intriguing proposition to invest with them? Think about this for a second. Who wouldn't want to invest alongside the highest net worth families in America as a partner, benefiting from all their resources to find the best deals? It's almost unheard of to have such an opportunity, as you will hear in today's show. But one of my clients is just such a family. Multi-generational, ultra-high net worth, very conservative, very successful, who, for the first time in their 100-plus year history, are inviting individual investors to join them as partners. So it was to find out more that I invited Richard Wilson, who is the country's foremost expert on family offices, to join me in today's episode. You're going to learn in detail about family offices, how they're structured, how they think, operate and invest, and what you need to do to get in front of this vital audience as you raise capital. Oh, of course, there is the totally predictable spoiler, right? In order to be successful with family offices, you absolutely need a solid, professional digital presence to stand a chance. And to find out exactly how to do this, just go to the podcast page at gowercrowd.com. Check out the whiteboard workshop that I put together for you, where I'll walk you through the investor acquisition system in great detail, so you can stand out when talking to family offices and any other capital source. And that's all at gowercrowd.com on the podcast page. But for right now, it is my great pleasure to introduce you to the country's top expert on family offices, Richard C. Wilson of the Family Office Club. Richard, I'm so happy to meet you. Thank you very much indeed for being on my show. And I would love to know, before we even start talking about you and your background, tell me, what is a family office?
Sure. Well, a family office is really a ultra wealthy, holistic wealth management solution. So there's many variations of it, but the way to think about it is that if you're worth $100,000 and you make a mistake that costs you 10% in taxation or your net worth, it's not that expensive. It's $10,000 that you lost. If you're worth 10 million or 50 million or 400 million and you make a 10% mistake, you could have paid for a full-time team to prevent that one mistake. And it gets worse than that, is that you're much more likely to make the mistake because you're very, very busy and you have 20 LLCs and 120 employees, et cetera. And there's many more opportunities per year to make those types of mistakes, and they're all much more painful. So people need more protection and play a better defense against regulators, taxes, mistakes, but also a better offense on planning, investment, strategy, opportunity.
Okay, so that's a really interesting answer. Let me drill down on that a little bit. So the assumption that you're making in giving me that answer is that a family office is a team of people. Is that correct? Tell me what that means exactly, and what does ultra high net worth mean? Like, where do the numbers start to kick in that somebody with a certain amount of wealth would start to employ?
Maybe at like $7 to $10 million of net worth, somebody could go and hire what's called a multifamily office, someone who serves maybe 50 or 200 different families that are worth 7 million to 50 million each. Those are called multifamily offices, and that starts at 10 million. And if you're worth 15, 20, 30 million or more, you might have what's called a virtual family office, meaning that you have one or two full-time people, you outsource the rest, keep things very lean because you don't have 300 million in assets, so you can't be spending 2 million on overhead per year. You'll drain yourself. And then there's a full-fledged single family office, and that's typically when you're worth 50 or 100 million or a couple hundred million. And at that point, it's a team dedicated just to your wealth. So those are the three types and the three kind of phases that usually go with those levels of net worth.
That's interesting. So at the lower end of the scale, at the 7 to 10 million, why would you hire, how is the team that you hire? You talked about multifamily office, right? So this is a group of people who specifically manage the assets of a family. Presumably that's the implication. How is that any different from an RIA or a wealth manager, for example, at that level?
Well, in the United States, at least, every multifamily office has to be registered as an RIA. So it's really just a type of RIA. And it's a type that's going to be more holistic. You're almost always going to be passing money on to kids, or you at least have charitable planning to be doing when you're at that level. So more multi-generational thoughts and structures need to go into place, more complex estate planning, and you can afford to pay more for your tax planning when you're at that level. Because even if it costs you $200,000 in estate and tax planning, you might be saving $1 million. If you're only worth 1 million, you can't spend 200,000 to save 100,000, right? So the larger you get, the more there's an ROI on the tax planning, estate planning, et cetera. And that kind of comes with having a multifamily office.
That's really interesting. So my experience of family offices is slightly different. That is that families themselves hire staff to assist them run their business. And part of that process is wealth management. So you're talking about actual family offices being a separate entity to the wealth holding family. Is that correct?
Right, that's correct. There's both types. There's over 10,000 single family offices globally where it's a dedicated team that the family has hired. But then there's over 5,000, maybe close to 7,000 of these multifamily offices as well, which are like wealth management firms for the ultra wealthy. There's both types out there, but in both types could be investing in real estate deals or, backing a real estate fund manager, et cetera.
And what do they look for when they invest? Like, what's the mentality, and what can we learn from that kind of investing?
Sure.
What can mortals learn from that kind of investing? That's what I'm asking.
I think that the number one thing they look for is how do they get high conviction, which usually means how do they get high trust in the team, the opportunity, the industry. Is it local to them? Is it related to the space where they created their wealth? If the family is based in Singapore and they made their money in manufacturing out of Malaysia, it's going to be hard for them to invest maybe in data centers based in Texas, right? But if they're based in Dallas, Texas, and they made their money in, selling a company to Amazon, then investing in a data center in Texas might be relatively straightforward, or even a multifamily property that's in their own backyard. So local to an asset, or they understand the industry, or they can gain trust in the team at a very high level. Those are three really important things they look for, more than high returns, because they know that those things are what protects their returns.
Familiarity with the asset class that you're talking about.
Yeah, and the team, and trust with the team. A lot of people go around and they say, oh, we've got the lowest risk investment you're going to see. We have the best returns. We have all these things that are just metrics. And until the family gets to know you, they don't care at all. And if you think that what's going to make the difference is your sky high promised returns, it makes you look like an amateur in their eyes, because you look like someone who's over promising and is okay with under delivering. And they want to work with people that over deliver and under promise. So saying something is low risk or no risk or the best returns you'll ever see just kind of reeks of like amateurism, and they'll just go dark on you instantly.
All right, so let's drill down on that, because that's a fascinating idea. And this is actually the heart of what I wanted to talk to you about.
Sure.
So the distinction that I just want to be sure we're making the right distinction. There are two entities. One is the family itself. So a family has acquired wealth over the generations, or in one generation for example, sold a tech company, right? Let's just
Right.
pick an example.
Right.
And then they have hired an external team to invest their wealth for them, right?
Right.
And that's what always going to be encompassing tax strategies, et cetera, et cetera.
Right.
So what you just described was an investment in now a third party, right? Like a data center operator who comes
Right.
to the family. So that operator is going to come to the family or to the office that manages the family's wealth.
Well, I mean, it's a great question because families always want a family office, usually because they want to remain in control of some of the strategy or implementation. So many times, unless the family created their wealth in wealth management or commodity trading, the stock market, et cetera, or running a hedge fund, they'll outsource that part and keep the part internal that's real estate maybe, or that is related to healthcare because they made their money in healthcare or hospitality, et cetera. So the parts they keep internally, it doesn't mean that they are going to be running the strategy. If they're a big enough family, they might just be the chairman, and they might have 100 employees that are running the strategy, but they are deciding on the strategy, hiring the top talent, making sure the ship's headed in the right direction. So the short answer, though, is it's always more powerful, if you can, to win over the principal of the family. Because even if they have an investment committee, unless it's third or fourth generation and it's a game of don't lose great grandpa's money, then even in an investment committee, there's one vote that counts the most, and it's the principal, and everyone else is just giving him feedback. But if you can win over the principal, then you've won over the investment allocation. But there are full-time professionals whose jobs are to screen investments, analyze investments, source investments. They're the ones that go to the conferences, like through the Family Office Club. We host 30 events a year, and their job is to sort things out. So the principal might get an email and then send it to his CEO, Pat, and say, hey, Pat, analyze this. Should we be looking at this? And then he trusts Pat's decision. But if for some reason or some way you can build a relationship with the principal, it's obviously the strongest move. It's just oftentimes not possible as a starting point.
Okay, so that's interesting. You described a bifurcation of the investments. One is the operating business, is that right? And then the other is...
Yeah, there's really three parts. There's traditional wealth management, where you just diversify to the extreme. Then there are real estate investments. Usually over 80% of those are cash flowing real estate, sleep at night, collateral, waited out if things go badly, real estate part of your portfolio. And the third area is operating businesses. And if the family made their money in real estate, that operating business part might be running hotels or running property management. But for most families, those are the three compartments. And so families really need to decide what they're going to outsource versus keep internally based on what they're strong in.
So tell me something about the philosophy of investing that a family, when I use the term family office, I think of the family, right? That decision maker who is protecting three generations of wealth. How are they thinking when it comes to investments that they make?
Usually they're thinking that they need what they usually think at the beginning is much different than what they learn to think over time. I found when they first become wealthy, they often make very expensive mistakes. They buy an overly priced personal residence they think is their dream home that they get bored of 2 years later, and now they can't sell because they bought it at top of the market price and had been on the market for 8 years when they bought it. Many times they spread money around to their brother-in-law and every person that pitches them an idea until they realize now that many of them are losing their money. So over time, they learn, the smart ones, in my opinion, learn to focus. And they might take a flyer on 2 to 5% of their net worth on, random ideas that come to them. But most of them learn to focus and really try to say, okay, in real estate, let's just focus on these 2 types of asset classes or 3 types of real estate investments. And in operating businesses, let's only invest in healthcare and only healthcare deals that meet this criteria if they made their wealth in healthcare or manufacturing or technology. And so the golden thread is that most families should be focusing on where they created their wealth and on where they have an advantage investing, not looking at direct investments like the stock market and spreading their money out across 200 different CEOs and 20 different industries that's a recipe for losing a lot of money as a family office. So it really is about focus for a lot of family offices once they've gotten formalized and know what they're doing.
Richard, what is the difference in your experience between the way old money invests and new money? You've kind of alluded to it, but let's talk about somebody who's third generation, for example.
Sure.
High net
Yeah,
worth.
third, fourth generation, almost always it's about diversification. Many times, like people like to claim to be part of a family when that family is worth hundreds of millions of dollars for obvious reasons. So even if you just have two kids and they have two kids and they have two kids, etc., you have a lot of people now that have a claim to part of the money. So even $100 million, you divide that by 12 or 16, there's not that much to go into an investment portfolio once you pay for college and residences and medical emergencies and taxation along the way at different life events. So if the family doesn't really inspire and carry on the values of entrepreneurism, and there's not another wealth creation event, that the wealth really dissipates by that time unless it is 500 million or $1 billion in net worth. So it's usually a very strong diversification game and just diversifying assets all over the place for the long term versus being aggressive or entrepreneurial, where first, second generation family usually will spend more money. They might have 2 to 4 private jets instead of no private jet or one. They might, be traveling the world more often and doing things that they think are fun, like buying businesses and trying to build. Like a father-son client of mine is a $200 million family. They just had a big exit, and they're looking to buy a couple companies at around 10, 20 million and build another $100 million revenue company and sell it again. And it's what they enjoy doing and how they're passing on values. So that's very different than what a third, fourth generation family would do.
That's interesting. So actually, that was my next question. So when you do look at, you've talked about building wealth or over the generations. So what do you see then? What is the mentality or philosophy of a third generation family that is looking to build wealth? Are they looking to preserve wealth, or just explain to me what is the thinking?
Sure. Usually they're just looking to preserve wealth, and they just want something that's ultra safe and might just grow their wealth 6 to 9% a year, maybe up to 12% a year. But they're really just looking for, a conservative return that has a limited downside, and they'd rather make 6% with little downside than try to make 12% with moderate downside.
And what kind of time horizons, Richard?
Most families have really long time horizons, but because of where we are in the economic cycle, it's really important for families to understand how something's going to perform when the cycle changes and whether they're going to be forced to go liquid when it's bad time to go liquid. They want to know that they might be patient, but if they're in somebody's investment vehicle and the head of that investment vehicle is forced to sell after 7 years, it might be a bad time to sell. So their time horizon is usually long, but they're sensitive to the time horizons they get put into and who they co-invest with. And they don't like to have a huge amount of their capital be all illiquid usually. So they want to have some varied liquidity timing so that if an opportunity comes up, they're going to have some capital becoming available.
That's interesting. So during a recession, they still want to have some liquidity to be able to capitalize on. I mean, my field is
Right.
real estate, as you know, but to capitalize on distressed real estate, for example.
Right. For sure.
So thinking about, I'll pick a specific example, downtown office buildings, right? So these are typically held by institutions or family offices, high net worth, ultra high net worth family offices. So explain to me the difference and comparison between an institutional investor, a pension fund or an endowment, and an ultra high net worth family or family office.
Sure. So I know one group that's built up $1 billion portfolio, in that space, and they've done so by going to families that are very patient, that just want to clip coupons, and they try to buy properties at a good 8%, type cap rate in a non-gateway city, so it's not overpriced. And it's a good example of how they're able to do that is they go to people who are needing to sell. They need to clean up something off their balance sheet. Maybe they're over allocated at their endowment fund, or The private equity fund might be a very large fund. So you'd think that they would be always very smart on what price they get on these properties, but they're able to buy things at an 8 cap because the fund has to sell and there's not too many buyers in the market and they need a credible buyer. So this group is able to come in and then they just don't have any plans to sell the asset. They hold on to it, clip the coupons, refinance out, 6 to 9 years later, and then they are able to, just sit on that asset over time until somebody offers them something too good to refuse. They sometimes don't even have a plan for an exit. They just say, well, if it's profiting us a certain amount that's healthy, why would we sell? They would have to go find another investment that gives us that cash flow.
So how do they differ then in terms of their investment philosophy to an institution? Can you describe them as being similar in investment strategy to institutions?
I think they're usually very different because one, they have the ability in part of their portfolio to be very active and have direct control, where most institutions go through fund managers or maybe a co-investment group of some type, where the family could go direct if they want to and own an asset and just work with a property manager. Most institutions don't do that. Family offices could be more patient than most institutions. If something's not working out, as long as the principal believes in it, then they don't have to worry about getting fired. The CIO at an endowment fund can always get fired. Even the president of the university could get fired over the endowment fund going poorly. With the principal, it's his own money. It's never their own money at an institution. You're always on the block to get fired. So you want to do very conservative things and follow the herd. Family offices want to be in front of the herd, and they want to sell into the herd and buy the straggler who couldn't keep up with the herd or get ahead of it. So family offices can be more agile or more patient, and they can't be fired by themselves. The CIO could, but the principal can't. And I think that many times they like to be more creative in their structures, like a joint venture or getting in on a deal on superior terms because they can help strategically on the deal. So I think they're more entrepreneurial for sure.
Richard, I'm going to start pivoting to this slightly different, nuanced approach in a moment, but let me ask you a couple of questions before I get there. One is, you've talked about wealth preservation as being important. So what are the actual strategies that a family will employ to ensure wealth preservation or to reinforce wealth preservation over the generations?
Sure. I mean, one is obviously good trust estate tax planning. Another one is having true diversification across funds and commodities and stock market, et cetera. Another one is getting cash flowing hard asset real estate in place that is in good quality locations. It doesn't have to be downtown San Francisco or New York, but locations that are not overpriced, but not in the middle of nowhere, next to some field in Nebraska either, and have it be so that it is cash flowing from the start. So you don't do some crazy condo conversion for a big percentage of your wealth. And instead you're going into things that even in the worst economy, multifamily properties typically were, leased up at 70% plus, and self-storage and senior living did decently well. So going into some things that are in areas where you're high conviction that in the worst case scenario, it's still going to meet its debt service plus a nice buffer, I think is something that allows people to sleep at night. And many families have, $1 million a month in income goals and different income related goals. So they don't even have to sell the asset to produce the return. Just the income coming off the assets pays for their lifestyle and their family.
So there you talked about debt coverage. I actually thought you were going to, when I asked wealth preservation strategies, I thought the first thing you were going to say was not having too much debt. But tell me about how families do view debt and the relationship between having wealth, cash wealth, and taking on debt.
Yeah, I mean, a lot of families love to be the provider of debt with good collateral behind it. So they might be okay as an investor with a 60 or 65% LTV, but they may not like going into something that's 70, 75, 80%, especially if they don't have control over what happens and if a bad situation comes up. But then, I've dealt with many clients that lend out money, like hard money lenders or bridge loans for multifamily or other types of real estate projects. And they too like to be at that 60% or 65% rate when they're lending out money as well, just so in a worst case scenario, they could break even if things went down by 35% and it was a messy process. So I think that family offices typically do use debt, but they have the ability to maybe come in and close in 10 days using cash and then worry about debt the next month and work through shopping and finding the best debt deal. But if they need to, they can close using cash and not have to use the debt.
Right, but they also, so do they also keep cash reserves for paying down debt in the event of a downturn in the economy where those debt service ratios are getting tighter?
Yeah, a lot of them are sitting on more cash now than they have historically because they're getting ready to buy when things go down. And I think that many, if they have a high cash balance, their bank will offer them a 1 or 2% line of credit against that big cash balance. Many family offices don't know how to use that, or they're not using that wisely. And they could be arbitraging that with having some hard money loans out there with collateral behind it, if appropriate for their level of risk, just taking some of that 1 or 2% cost of debt and using that to lend out at 10% or 12, 13% is something that I think some families do for sure, but a lot of families kind of overlook that possibility right now. But I think late in the cycle, people would rather do debt than equity, all else equal. But a lot of people see the real estate market like the stock market, and they don't want to pull completely in or out of the market. It's just how much they're putting their foot on their gas and how careful they are in certain types of investments, like development projects that might take years and relies upon financing, et cetera.
So here's the nuance, Richard, that I wanted to ask you about.
Sure.
Everything that you've described and the several hundred videos that you've got on YouTube that I can see all talk about how do you solicit from a family office to invest in your deal, right? Basically.
Right.
As well as some, high-level intelligence on how to manage a family office, etc. But here's my question. What opportunities are there typically to invest with a family office? Not the other way around. Not to say invest with me. For me to say you're $1 billion, $100 million family office, you've got all these strategies and all these team that are helping you preserve wealth and maintain it. How do I invest with you? Have you ever seen that?
Yeah, for sure. For sure, I've seen that. With real estate families, it seems to happen naturally that people want access to their deals. So even without trying, they'll have some people come in with them on deals, or they might have a little fund for friends and family. Even if it's not something that's really a P&L they're excited about growing. Others in the real estate space became family offices because they were so good at syndicating deals. They're now $1 billion plus CRE firm, has a family office, but they made their money off being an independent sponsor. And I've got a client such as that I'm doing some work with right now. But yeah, I definitely have seen that. And I think that the trick to being able to do that would be to figure out how you can add strategic value. Can you source a deal for them? Can you introduce them to another family or two? Can you help them save money? Can you help them in one of their other operating businesses? Can you co-locate and sublease office space from them? Can you employ their daughter at your firm because she's genuinely a good team member to have around? So, finding a way to add value first is the right way to go with family offices, either direction you want things to go.
That's really interesting. So in those cases, what kind of minimums do you expect to see an outsider be expected to invest with the family?
Sure. I mean, a lot of family offices, people are surprised to hear, even if they're worth 50 million or 100 million, they might test out an investment at 100,000, 250,000 to just see how they get treated and see how it works, if it's possible to do so. So because of that mentality, if the family is at the 50 or $100 million level, they might be totally fine with somebody coming in just with 100,000 or 250,000. If you're adding strategic value, you might have saved them 100,000 by that thing you did for them. So them doing you a favor to allow you to come in, they might like that because now they know that you're aligned. And if the deal goes well, you both win. If it doesn't, then you both lose. So they would prefer you come in for 100,000 if there's other ways to be working with you than for you not to be in the deal. And I think that's an important point. They like alignment, and that matters more than the numbers, I think.
So if you have, so let me kind of refine my question a little bit.
Sure.
And assume no value add, right? No value.
Okay.
I'm not hiring your daughter.
Yeah.
I'm not going to bring tenants. I'm totally passive. I've just got some money. I'm running a company and I want to invest because I want whatever value, right? How do I, then first of all, is it doable? And second, have you seen it? And second, what would the minimums be in those circumstances?
Yeah, for sure. I've seen it. Probably 250,000 or 500,000 would get their attention. If the family is worth more than 200 or 300 million, they might not want to mess around with $100,000 checks. So, it probably started at 250 to 500,000. Some will tell you it's 1 million, but if you say, hey, well, I want to come in for 250, might be able to negotiate something. So what people say the minimums are versus the actual reality sometimes changes when the actual deal comes to the table. And if they like you and see you're not going to be a pain to deal with as an investor, that always helps. And many times, since this is a real estate related, show, many times real estate families have such good tax positions, they need other assets to be making them money just because they have more in tax write-offs than they have in profits to use them for. So some real estate families have, like one of my clients just acquired 50 franchise locations. And just an example, they sometimes have other investment opportunities that are not real estate related, but are high level, well thought out, tax efficient type models just because of who they've become while building their $1 billion real estate portfolio.
Richard, so I don't want to take up too much more of your time. I really value your time. So I'm going to pivot slightly to a couple of other ideas. My podcast is entirely focused on digital marketing best practices. So I'd love to talk to you about that. Again, slightly nuanced for the family office space. But let me ask you one final question on investing with a family office. Let's say you don't have $250,000 or $500,000 to invest, but you want to mimic the investment strategy of a family office. A family office, again, I'm talking about a family, right?
Right.
What would be the kind of the key things to be looking for in your own investment strategy to do that?
Yeah, really good question. So I think the key is to look at your own strengths, see where you're very strong, where you can do an excellent job, see where there is little competition within a sub niche of a strategy or a sub market, and see where there's a lot of demand and inevitable more future demand. So if you can align those three things where you're only saying yes to things where you're very strong, little competition, but big demand, then that is a solution that's going to bring a lot of power and it's going to grow your net worth. Nobody goes to their wealth advisor and says, diversify me in 200 things so I can be worth $100 million instead of 1 million. Like, it's not going to happen, right? So you have to take some concentrated bets and risks that have strategy behind them, and you're not going to do well if it doesn't play to your strengths or if it's overcrowded. So you have to find that niche. It doesn't mean switching from senior living to doing some blockchain AI mobile app. It means going from senior living where you're buying assets to maybe doing a digital version where there's a platform for it, or using AI within the senior living center to identify that the grandma walking down the hall is about to fall over and faint, and you know that before she does because of some hallway monitor, and you prevent, medical costs or something,
I see. Fascinating. All right. So let's talk about communicating with family offices. Again, as you know, my position or my angle is entirely digital marketing. So what are the best ways to communicate with a family office? Actually, let me ask you this instead.
Sure.
When a family office, again, a family first considers investing with somebody, a real estate sponsor, what's the first thing that they do in their research? Really, literally the first thing. They hear your name. What's the first thing they're going to do?
Honestly, in the first 3 to 5 seconds, they've already cut out 90% of those that interact with them as someone they'll never do business with, probably. Usually in the first 5 to 10 seconds, somebody comes off as either stressed out or rushing them or rude or unkept or or comes off as amateur by saying their deal has no risk, or for some reason it just seems like not the type of person they want to deal with. That eliminates most people right off the bat. But the very first thing that they'll do is look at whether they've heard this 100 times before, and it just sounds like, oh, okay, so you buy, C-class apartment buildings and do a 10K renovation and then raise rents and sell it 4 years later. That's what 800 other people do in the US as well. So if you can't say what you do in a unique way in a single sentence, I think you're pretty much dead, because a lot of these families see a good amount of deal flow. And if it doesn't sound unique instantly, and they don't lean forward and say, oh, well, how do you do that? Or that's interesting, then they just move on. That's like the second kind of quick test. And then I think a lot of family offices won't take something more serious than the founder takes it for themselves. So if the founder has a company and they didn't bother to get a logo put together, or they don't bother to have a website, or they can't clearly say what they do in a way that's meaningful and unique, then the family office says, well, why should I waste my time if you really don't care about your own business much? So we just find a good rule of thumb is that no one's going to take your real estate firm more seriously than you take it yourself. So if you're too lazy to put together a website these days, or business cards, or a professional email address, just get out of the industry. Like,
Still got a Hotmail account.
Yeah, exactly. Like, it's laughable to even have to say that, right? But it's like, we get it. Your expertise is real estate, but if you don't care to take one day and 5 to 10K to make it professional, then you shouldn't be in front of me, is what the family office is thinking.
All right. So I'm glad that you went down that route, because you were certainly describing, very interesting, that those first seconds of interaction is fascinating. I mean, human interaction and the nonverbal communication and the way that works is really a fascinating idea. How does that work online then? So I'm glad to say, I'm very happy that you took me down that route. So what else does a family look for, right? So now online, what they're doing is that they're running, I'm just going to put words into your mouth, Google search, right? All right, so here I met this guy, right? And I've heard his name, I'm interested in finding out more. What are they looking for online?
Right, I mean, I think they're looking for social proof, authority, credibility, professionalism, consistent commitment. If it looks like last year you're doing blockchain and this year you're doing multifamily and now you're talking about doing opportunity zones and it seems to always be changing, then that's bad. If they find nothing on you anywhere, that's bad. If they go on LinkedIn and you have no picture on your profile thing, then that's bad. And I think that people want to see someone who's consistent and they're generous with their thought leadership and their ideas, because they're not limited. You always have more ideas and insights. So you're not scared that someone's going to take your one golden idea and run away with it. If you go out of business because someone hears one idea that you say, then you got to put your nose down, come up with some more ideas. Yeah, exactly. So I think they want to see that. And I think social proof of, like, one individual today asked if I wanted to buy his digital asset related to his venture capital angel investor network. I'm like, oh, that's an interesting idea. I'll take a look. But, it only had 138 subscribers on the channel. And no problem. I only had 138 at one time as well. It's not like I'm king of the world of how to do all this stuff. But, if someone has a YouTube channel and they have 2 views on it, or they have a blog and there's only one blog post that was written in 2014, it just, showing that you're active in the business, consistent, professional, and when someone stops and actually reads your book or listens to the podcast, there's some actual content there, and it's not just knocked out stuff that doesn't mean anything. I think all that stuff is pretty important.
Richard, thanks so much for saying that. I'm really grateful, because that's exactly what I build. Right, for clients. But there's not many, it's remarkable actually that in real estate sponsors, they are not good at it. But you know why? Is because since 1933 it was prohibited. You couldn't put stuff online. So look, I'm a real estate guy. I've been in real estate since they invented dirt. Right. And I did everything in person. Right. So what that personality, interaction's all about. But coming into the digital space is a big deal. Anyway, let's wrap up with 3 sign-off questions,
Sure.
but I've actually got a fourth that I have to ask you because it's so beautiful. Tell me the history of your crest.
Sure. Well, in the 1500s in England is where the crest came from. I think it was 1546. And my grandpa, whose name was Richard Wilson as well by chance, researched our family back to like the 1700s. And then he couldn't find the records to go back all the way to the 1500s. But essentially, one of my ancestors, John Wilson, came over and founded the first Presbyterian church in Boston. And then, from there, our family's been in the Northeast and the Midwest, but we're from England originally. And I grew up with a wooden shield with the family crest on it in my dad's office growing up. And I was always starting businesses and watched him grow a business that he started. And so when I started my business, at first I had this really ugly logo. And then I just realized that since we're in the family office space, I should just use my own family crest and it would be like a natural, easy logo. It took me a couple of years to realize that. And so I just took a picture of it and got a graphic designer just to modernize the image a little bit. And you can't read it there, but it says res non verba on the red banner, which means kind of actions, not words. And that was nicely in line with just kind of, good business rule to get things done instead of just talking about it. So we like to use that. But importantly, we have our core values on the wall, on the other wall that you can't see here. And our number one value that I think would be good for everyone to hear related to family offices is ruthless integrity. So it means like alignment and integration of everything, from like who you do a podcast interview with, to what clothes you wear, to where you live and what food you eat and who's on your team and who you marry and how you spend your personal time. If all those things are aligned, then family offices want to work with you because your strengths are all pointed in alignment with where they want to go. But if you're not aligned with who they are, or you show up in sweatpants and a torn shirt, or you don't have a website, or you're swearing and you're being rude to everybody around you, then, like my latest family office client, by chance, I don't drink alcohol and he doesn't drink either. So we went out and got some gelato after a long business dinner. And to me, that was like a very nice alignment. So I think family offices, they want to see that like across your business. Not that you don't drink, but just that you're aligned with your own strategy and hopefully aligned with them in most ways.
Values, right? Your kind of core.
Yeah.
Richard, what a pleasure talking to you. Let me ask you 3 sign-off questions that I ask all of my guests, if I may.
Sure.
First one, and it's all about digital media, actually.
Sure.
So for somebody starting out, we've talked about real estate sponsors not having presence online. So for somebody starting out syndicating deals online, what do you suppose is the most important thing that they should keep in mind if they want to stand out in front of a family office?
I think it's just adding as much value as possible. If you hold back, then people will never know how smart you are. It's the game of people aren't hiring you because you're a rocket scientist. They're hiring you because you're the best positioned rocket scientist. You still have to be the scientist and know how to make the rocket fly. But at the end of the day, the guy who gets $1 billion firm, it's because he's known as the rocket scientist, not because he got a 4.0 in his PhD program. That's just table stakes. That doesn't mean you deserve the capital or you're going to get it.
That's really interesting. It sounds almost like something that's driven your success online. So let me ask you that. You've been successful online. You're very present. You're on yet another podcast. So you're aware of the power of podcasts. So what's been the hardest lesson that you've learned in your online life?
Hardest lesson. I think it is just the power of niching down to the right level, and choosing your battles. So once you find that the strategy works, all of a sudden your brain opens up and said, "Whoa, I could do this, and I could do this, and I could do that." So picking your sandbox and your niche so that you have the little competition, but big growing demand, and it uses your strengths, picking the right niche that doesn't make you abandon your previous niche that might have been this big. And now you're going to hit this little sub niche and have that all be congruent and synergistic with your long-term platform, your history, your team, your ability to execute. It's a multifaceted thing that you have to really meditate on as you grow. And I know a lot of people might listen to this and are just trying to get this to work for them for the first time. But the hardest thing, I think, is once it works, there's 92 different ways to be moving forward. So you need to be thinking about it in a multifaceted way to make sure that you've refined the next step to be in alignment with where you're trying to go, so that your strategy is cohesive and it makes sense over the long term.
And my last question. So again, with a focus on your online persona, your online activity, what are your personal key daily habits for being successful online? Daily habits.
I do one social media update every day. I check my LinkedIn messages every day, and then I'm on top of my email, because a lot of my leads come in and my team can be answering most of the emails. And then I just have a rule where on Monday, Wednesday, Fridays, I only answer 30 emails, and the rest have to wait till evening time, or Tuesday, Thursdays, I only answer 60 per day, because I realize otherwise I can spend my whole day answering emails. And on Monday, Wednesday, Friday, I want to get big things done that move the needle. And on Tuesday, Thursday, okay, spend more time doing emails, that's fine. Got to answer them sometime. And if I can't get back to everybody on planet Earth who decides to randomly email me, that's not really an obligation I care about. I'll just have my team email them back, or they can write a letter to my complaint department, I guess. But I try to be really responsive to people. And I think it's important to be responsive. So I really try not to have anyone flat out ignored. I might just say, hey, that call needs to be with John, or no, I can't meet to sell you a $200 a month membership in the Family Office Club. You got to meet with Adriana, because that's what my 20-person team is here for. And just nicely dissipating that energy to the other people on the team in a way that they're not insulted or put off. Because when you're known as like the guy to talk to on real estate crowdfunding, then people want to talk to Adam. They don't want to talk to Adriana or Andres at some level, right? So for anyone who's going through that, I've just found the line to like, hey, we've produced more YouTube videos and published 13 books and done 1,800 videos, more than all of our competition combined. The only way I can keep adding that much value is that I don't take a meeting about this. My team member is equipped to do a great job talking to you. And then, they either understand or they don't. And at that point, you've done your best to try to, explain it.
Richard, what a pleasure talking to you. Thank you so much for not only answering my email, but also for taking out some time to be on the podcast. Thank you.
Yeah, of course. It was fun. And you're much more dynamic, interactive, good podcaster than most people I've done the podcast with. So I'm sure your listeners, listen in part just because you're actually good at doing it and not just kind of monotone, dry, knocking it out. So I appreciate it.
Thanks so much. It's all caffeine. I told you when we started. It's just massive quantities of caffeine.
Great. Awesome. Yeah, well, thanks for the opportunity. I appreciate it.
That was Richard Wilson of the Family Office Club. Fascinating, right? Now think about how compelling that is to invest with a family office. Exclusivity, diligence, consistency, sustainability, long-term wealth, and ongoing passive income streams. Are you a family office? Whether you are or not, if you're raising capital online, be sure to go to the podcast page at gowercrowd.com and watch the whiteboard workshop there at the top of the page, where you'll learn exactly how to position yourself online to raise as much capital as you need. Again, that's on the podcast page at gowercrowd.com. Hey, thanks for listening. And thank you, Richard C. Wilson of the Family Office Club, for spending your time with us today. Really appreciate it. It was a great pleasure. That's all for this episode. I'll see you next time. And for now, this is Dr. Adam Gower signing off.